So welcome everybody. My name is Jennifer Zach. I'm with the New York, New Jersey Trail Conference. This is part 2 of our Making the Most of Our Legacy series. First and foremost, I would like to thank the team at Cereus Financial for hosting and being a part of our Making the Most of Our Legacy. Always having a plan and developing one to continue your legacy, especially stuff that are near and dear and passionate to your heart, is very important. And I think it's becoming at the forefront during these difficult times. People are definitely looking to maximize their legacy. And this is a great way to understand it. I'm definitely learning a whole bunch about it myself. So I'm really looking forward to hearing from Michael tonight. So this is, as I was saying, the second part of our series, and the Trail Conference has been hosting virtual webinars engaging our community throughout the quarantine and COVID. So first and foremost, I really hope that each of you are all doing well. And that tonight is, a good night and a happy one. So we're turning 100, so I just wanted to mention that as well. So to celebrate that, we are going to be having a trail-a-thon, 100 miles for 100 years of service challenge. So it's officially starting on September 14th and will run in through October 31st. But you are able to register and start up your fundraising page and get the excitement behind it. So I hope that each of you, I know the Daniels are already signed up, so I hope you guys are excited and ready for that as well. So I will send out the link in my thank you notification tomorrow to encourage everybody to sign up. You can tick your miles off any way that you want. It doesn't have to be just on the trail. It can be logging your miles as you leave your house to get your mail. So we just really want everybody to raise awareness and be really excited about the Trail Conference. 100 miles is a really lofty goal, and I completely get that, but it's a great way to have fun. And I think especially during these times, it's something that really nice to have something to motivate you. So as I mentioned earlier, this series is put on by Cereus Financial Advisors. And tonight is Michael Dunne. He is a financial advisor with the firm. The firm is located in Franklin Lakes, which is our neighbor to our headquarters here in Mahwah. So Michael, if you're ready, I'm ready to pass it on over.
Okay, great, Jennifer, thank you.
Before you begin, I do want to say if anybody has any questions, feel free to chat it, and or it's a very small group, we can kind of just say, oh, I have a question really quick, and we can do it that way. Or if you want to chat it, we can have that. I can't see it because I'm screen sharing the chat. So yeah, so either shout it out or just chat it, and at the end, I'll make sure that your questions get answered. Okay, so Michael, just tell me also when I can hit the next slide.
Okay, so yes, so you see the cover page here, Qualified Charitable Distributions, or QCDs, is our topic for tonight. And Jennifer, if you could advance to the next slide, please. So Jennifer gave me a nice introduction. I won't bore you all with these details about my background, other than to perhaps add another small commercial for the New York, New Jersey Trail Conference, and in particular, their annual gala auction. Since joining the Trail Conference myself a couple of years ago, one of the most fun things that I've done with the organization is to bid on a number of offerings in their auctions. And I've won a few things, and it's a lot of fun, and the prizes are great. This also has some relevance to what I'll be talking about soon as it relates to qualified charitable distributions, and I'll let you know as we get to that a little bit later in the webinar. If you can shift to the next page, please. So our firm, Cereus Financial Advisors, is owned by my friend and colleague, David Haas, who's also on this call. As Jennifer mentioned, we're in Franklin Lakes, New Jersey. We are a registered investment advisor and registered in New York and New Jersey. We provide financial planning and wealth management services. And here are contact details if there's anything that we might be able to help you with now or in the future. If you go to the next slide. So I'm used to writing outlines from my school days, I suppose. Jennifer gave us a nice introduction, so I can start right in with the objective, and it'll be like starting a work week on Tuesday. So our objective tonight is to illustrate, hopefully, how a QCD might benefit not only charitable organizations like the New York, New Jersey Trail Conference, but also your own financial and tax situation. We'll walk through a definition, go over a couple of examples of how they work, then talk about some recent rule changes, regulatory changes, and law changes put forth by Congress. Touch on some things to know, other considerations, things to be careful about if and when you're considering doing a qualified charitable distribution. And then we'll wrap it up. So if you could move to the next page, please. All right, so what is a QCD? It is an otherwise taxable distribution from an IRA that's owned by an individual who is at least age 70 and a half, and it is paid directly from the IRA to a qualified charity. So as you may be familiar, perhaps from direct experience, or perhaps it is approaching, when you reach a certain age, which we will talk about shortly, the IRS requires that you begin taking money out of your IRAs. And the theory behind that is you put money into your IRAs on a pre-tax basis, hopefully years and years ago, and it's had a lot of chance to grow to help fund your retirement expenses. Since Congress gave you the break by not taxing you on the money going into the IRA, generally, when you reach a certain age, they want you to start withdrawing, and you will be taxed on those distributions when you start withdrawing. Those are the required minimum distributions. Well, looking at the second bullet point here, QCDs can be used to satisfy all or part of the amount you would otherwise be required to take, your RMD, from your IRA, up to an annual limit of $100,000. And we'll walk through an example of that shortly. One really nice thing about a QCD is that you can achieve tax savings kind of at both ends. So as I mentioned, going in, if you contributed to an IRA on a pre-tax basis, you weren't obviously taxed on that contribution. And when you take money out of your IRA through a QCD, you also don't get taxed on the amount of the QCD. So at both ends, going in and coming out, you have tax savings. So let's look at an example on the next slide. Okay, so this is an example where we have a hypothetical taxpayer who is age 72, who's required to take a $50,000 minimum annual distribution from their IRA. Taking an amount that large, by the way, would generally imply that that taxpayer has a pretty large IRA accumulated over the years, which is a nice position to be in. This taxpayer's tax filing status is married filing jointly, MFJ. We'll assume their tax break is 35%, and the taxpayer otherwise does not qualify to itemize their deductions on their tax return. One of the things this taxpayer wants to do is to contribute $10,000 to a charity. So the question is, how should the taxpayer do that? Should they contribute directly, or should they contribute through a qualified charitable distribution? So these two columns compare what the outcome would be. In column A, where they take the full required minimum distribution of $50,000 and then decide to contribute directly in cash from that, you can see the total distributions are $50,000. Since that is a fully taxable distribution, the tax on that at 35% is $17,500. after that, they would contribute $10,000 to charity. As the previous slide mentioned, when you do a qualified charitable distribution, you don't get a tax deduction for a charitable contribution when it's coming out of your IRA. Looking then at column B, this taxpayer decides to take part of their required minimum distribution and contribute to charity through a QCD. So of the total of $50,000 they're required to take out, they take out 40 as a taxable distribution, and they designate 10 as a QCD that goes directly to the charity. So the total distribution for this, from the IRA for the year is satisfied at $50,000, but they only get taxed on $40,000 of it. So you can see the tax savings on that. Instead of paying $17,500, you pay $14,000. So it is beneficial in this particular case to take part of your RMD in the form of a QCD and have that distributed directly to the charity. So one thing to note about this also is that if the taxpayer was eligible to itemize their deductions, depending on how much in itemized deductions they have, sorry, I'm just reading a note here. Thank you, David. David advised me to activate my camera, so hopefully you can all see me. If the taxpayer would be in a situation where they'd be itemizing deductions in this tax year, depending on the amount of those itemized deductions, the first approach, taking the full RMD and then contributing separately, could be as tax efficient as the QCD approach. And that would be because they'd contribute $10,000 in cash as a charitable contribution and get a 35% tax break on that, or $3,500. And you can see that that is the difference between these two methods. So you can make your situation almost indifferent if you're able to itemize deductions in this particular example. Let's move on to another example in the next slide. So this is a bit more complicated, and it's a different taxpayer situation as well. But what I wanted to illustrate here, and I think this slide will help bring together perhaps some ideas that were presented by David in episode 1 of our webinar series. So here we're comparing whether it is more or most beneficial to donate cash from the sale of appreciated securities against donating appreciated securities directly, or taking or making a donation via a qualified charitable distribution from your IRA. So this taxpayer situation is a bit more complicated. Let's walk through what their facts are. Number one, hopefully like all of us, this taxpayer wants to donate to charity. They happen to have appreciated securities worth $50,000. They paid $20,000 for them more than 1 year ago, so they're considered long-term capital gain or LTCG eligible. This investor is in the 35% tax bracket, which also means that the separate tax rate on long-term capital gains that they would fall into is 20%. And we also assume that this taxpayer can itemize deductions. It also happens that this taxpayer has a large IRA and they are of the age where they are required to take an RMD, or a required minimum distribution, from that IRA. And the amount they're required to take is $50,000. So you can see, very generally speaking, that these facts imply a pretty nice financial situation for this taxpayer. But what's the most efficient way that they can accomplish their goal of donating to charity? And we'll assume here that in columns A and B, they're taking the value of the securities and not adding any additional cash to their charitable donation. So if they sell the securities, they sell, they donate the cash from that sale of securities in column A. In column B, instead of selling the securities, they arrange to donate the securities directly to charity. I'll just call your attention to a red bullet point on the right side of this page. Not all charities are able to take donations of appreciated securities directly. Fortunately, the New York, New Jersey Trail Conference does have that capability. So this is one of the ways in which, if you haven't considered it previously, you could consider donating to NY and JTC. So column B, as I mentioned, is a donation directly of securities to a charitable organization. And then I'm comparing that also in column C, donating via a QCD. So let's walk through each of these scenarios and see how they work. As mentioned at the outset, so the value of the long-term gain eligible securities is $50,000. You see that on the top line in both columns A and column B. It costs the investors $20,000 to buy those securities more than 1 year ago, so their effective long-term capital gain before the sale, it's an unrealized long-term capital gain, is $30,000. In column A, the investor/taxpayer decides to sell those securities and pay the tax on them. At a 20% long-term capital gains rate, that results in a tax liability of $6,000. If you deduct that $6,000 from the value of the securities, $50,000, what's left over is what can go to the charity, in this case, $44,000. Donating $44,000 in cash to the charity can generate a tax savings, as we walk down the page to the next to the last line, of $15,400 at a 35% rate. This isn't their total tax savings because they did have to pay $6,000 long-term capital gains tax. So their total or net tax savings in column A is $9,400. Let's compare this now with doing the same thing except not selling the securities but donating them directly in column B. So same value, same long-term capital gain. Instead, the investor designates that these securities be donated directly to the charitable organization. In doing so, they avoid having to pay capital gains on that, capital gains tax on that gain. So the charity gets the full $50,000 value of those securities. The investor also gets a tax deduction for that full $50,000 worth of value given to the charity. So their tax savings for donating on their itemized deductions section of their tax return at a 35% rate is $17,500, a much bigger savings than column A. So if we're comparing column A and column B is clearly the preference in terms of additional tax savings and in terms of more money ultimately going to the charitable organization. Let's compare this now with column C. Instead of donating securities or selling securities and deciding to donate the proceeds, this investor tells their IRA custodian that they want to do a qualified charitable distribution and send $50,000 directly to the charitable organization or charitable organizations of their choice. If you look down to the proceeds to charitable organization, you can see they get the full $50,000. Next line down, the tax deduction for the charitable contribution in this case is zero. When you do a QCD, you don't get a charitable contribution deduction in that tax year. However, in the next line, you still achieved a tax savings for making the QCD. And for that, I'll call your attention to the second red bullet point on the right side of the page. By taking a QCD, you enabled yourself to avoid having to take a taxable required minimum distribution from your IRA, which would have been taxed at 35%. So effectively, you do achieve a 35% tax savings by doing a QCD. And the investor in this particular scenario would be indifferent between donating via column B or donating via column C. So let's move on to the next slide. So Congress has enacted some recent changes. And the first bullet point, the first item to call to your attention is specifically for this year, 2020. coronavirus relief as provided by the CARES Act. Congress has specifically waived the RMD requirement for this year. So if you're of an age where you would otherwise be required to take a required minimum distribution from your IRA, you don't have to do that this year. It's designed to give you a tax break. You don't have to take the money. It helps if you don't need to take the money and therefore don't have to pay tax on it. However, you could still decide to take a distribution if you needed the money. The Secure Act intended to update some rules and regulations surrounding helping Americans prepare better and save more for retirement. And in doing so, Congress has permanently changed the minimum age at which people need to begin taking required minimum distributions from their IRAs. It used to be age 70 and a half. They've moved it back to age 72. However, Congress did not change the age requirement for doing a QCD. So if you'll recall from a few slides ago, I mentioned that you have to be at least age 70 and a half in order to qualify to make a qualified charitable distribution from your IRA. That is still the case. You will not get any relief from your RMD if you are 70 and a half or age 71. Because you're not required to take an RMD until age 72. So it would seem that made it a little bit less attractive to make a QCD before you reach age 72. And this brings us to a planning question in the third bullet point. Could it still make sense to do a QCD anyway, when you otherwise wouldn't have to take an RMD from your IRA? Well, the answer to that is a definite maybe. Doing a QCD could still be an efficient way to contribute to a charitable organization, especially if you don't itemize deductions. You still can avoid being taxed on a distribution from your IRA by making it a qualified charitable distribution and having it go directly to the charity. This also would have the effect of reducing your overall IRA balance, which will get taxed in future years. Because after 2020, you'll begin to, or after you turn age 72, you'll need to begin taking RMDs and getting taxed on them. So depending on your situation, and it's something that can be looked at with your tax professional and or your financial planning professional, it may make sense to still consider a QCD, even in cases where you might not have to take an RMD quite just yet. So let's move on to the next slide. So here's a list of pointers, things that you need to keep in mind, perhaps things to watch out for and remember in proceeding or making going through the thought process and deciding whether or not doing a QCD makes sense for you. First of all, the recipient of a qualified charitable distribution must be a qualified charitable organization. So unlike the topic that we presented in the first episode of this webinar series on donor-advised funds, a QCD can't be made to a donor-advised fund. It has to go directly to a qualified charitable organization. To be safe, if you choose recognized public charities, 501c3 charities, like the New York, New Jersey Trail Conference, those are qualified organizations to receive QCDs. Secondly, a recipient of a QCD must receive the funds directly from your IRA custodian. So if you call Schwab or do so online, or wherever your IRA custodian might be, Vanguard, Fidelity, etc., tell them that you want to do a QCD. And for whatever the reason might be, it turns out that they make out a check in your name and they mail it to you. That's not a QCD. That's a taxable RMD that you'll have to pay tax on in that particular tax year. So you want to make sure they don't cut a check in your name. I've heard of instances where an IRA custodian writes a check in the name of the qualified charitable organization, but then they send it to the IRA owner. In that case, the IRA owner needs to then go out and forward that in the mail to the charitable organization, who can then deposit the check. So that, in that particular case, it still counts as a direct contribution from the IRA custodian and will count as a QCD. As a contributor, you must not receive a benefit from the charitable organization. So you recall that I mentioned that I enjoyed being an active bidder on the annual gala of silent auctions run by the Trail Conference. I can't do a QCD and use those proceeds to bid on stuff from the charity auction and win them. That would invalidate the tax treatment. So you've got to be sure that you're not satisfying, here's your chance at a prize by making this QCD. You want to make sure that it's, if it's perhaps other than a nominal type gift, a coffee mug or a cap or something like that, you've got to be sure that you're not receiving a benefit from the charitable organization in order to get the QCD tax treatment. You can do, in effect, multiple QCDs to various qualified charitable organizations in the same tax year, as long as you don't exceed the annual total limit of $100,000. You can contribute via a QCD up to the full amount of your required minimum distribution, up to $100,000. And this is counted on an individual basis. So if a married couple each has a large enough IRA and a large enough required minimum distribution, they each can contribute via QCD $100,000. So a married couple filing jointly can contribute up to $200,000 in a tax year through QCDs. The contributor has to donate by December 31st for it to count against their required minimum distribution for that particular tax year. It does not work like the IRA contribution rules where you can wait until April of the following year when you file your tax return. You've got to make sure that you designate your QCD and have that all done by December 31st of that particular tax year. The contributor should also be sure to tell their tax preparer that they've done a QCD. And I know from indirect personal experience, my wife is a practicing CPA, and one of her colleagues discovered almost by accident that their client had done a QCD. The Form 1099 that the IRA custodian sends to you after the end of the tax year indicates a distribution from the IRA, but it may not be necessarily very clear that that distribution was in the form of a QCD that went directly to the charity. So if you prepare your own taxes, obviously you can just give yourself a reminder, but if there's a tax preparer involved, make sure you tell them if you've done a QCD that you have in fact done so, and try to put together the paper trail that shows that for them. They might not otherwise know. A couple of cautions also, these last two bullet points. You're not allowed to do a QCD out of your 401k or your 401 or 403b retirement savings accounts from your employers or former employers. And the last bullet point, if you have a SEP IRA, one that you set up as a self-employed individual, or a simple IRA, which are similar plans but set up for small employer or smaller companies, you can't contribute a QCD from those types of accounts if you're in fact still contributing money into them through employment income. In both of these last two bullet point cases, though, 401k, 403b, SEP IRA, simple IRA, you can roll your 401k or 403b into an IRA and then do a QCD from an IRA. In the case of a SEP or simple, you can transfer to what we refer to as a traditional IRA, and then contribute via qualified charitable distribution from the traditional IRA type account. And I think that covers most of the considerations I wanted to talk about. If you could, Jennifer, move to the next slide, please. So I hope that I've been able to illustrate how QCDs can be a tax-efficient way to donate to charitable organizations. It benefits your own financial situation, and also is a great benefit to charitable organizations. And your noble intention to donate to charity is always notable and appreciated. It's really just another tool in your arsenal as you consider how best you want to support the organizations that you care about. However, because of the various things to keep in mind, you'll want to proceed carefully. So if you're unsure, or if you feel it's needed, make sure you work with your tax professional or financial planning professional to help you go through all of the considerations needed to help you do a qualified charitable distribution to the charitable organizations you want in the right way. David and I would be available and happy to assist if you don't already work with financial professionals, financial planning professionals, that is, with any questions you might have. And that's really it. I'll look forward to any questions you may have, and otherwise turn things back over to Jennifer.
Okay, thank you, Michael. I really appreciate that. Does anybody have any questions? No questions? Okay, well, before we go, I'm just going to put up my slides. And so there is, we wanted to share Half My DAF Challenge is still going on. It's a matching grant. It's running from May 5th through September 30th. And it is a nationwide initiative to fuel the nonprofit economy. And basically, a couple saw that there was just a pot of money sitting in donor-advised funds. So this is an incentive to motivate people to provide half of their donor-advised fund. You fill out a commitment form that you will be donating and gifting half of your donor-advised fund, and then that nominates that nonprofit to be selected for a matching gift. So if you have $12,000 in your donor-advised fund, by gifting half of that, it will make the Trail Conference eligible to receive a matching grant. And that would be matched. So if it was half of 12,000, 6,000. So if the Trail Conference was picked, that would be 6,000. So this was just an effort by a couple and their friends to kind of move the pot of money that people had. Donor advised funds are often referred to as parking lots. A lot of people just kind of have that there and then it sits. So this is kind of incentive during these really challenging times to kind of move those funds. So they did 2 rounds. One round was already in July, and 147 nonprofits were selected, and over $600,000 was donated. So the second round is coming up, and there's going to be $800,000. And I haven't checked, but when I checked for the July one, there was basically no nonprofits on the East Coast. So I hope that we've been getting the word out, and even if we're just nominated, that would be really fantastic. And just before we go, the 100 Miles for 100 Years Challenge, here's some of the little logistics. And again, I will share the registration. It's free to participate. The challenge actually starts the 14th of September through the October 31st to tick off 100 miles. It is a peer-to-peer fundraiser, so everyone will be encouraged to have their own fundraising page. There's fundraiser milestone prizes as well as milestone prizes. So again, we hope that everybody registers and, you know, gets a kick out of it. Again, thank you to Michael and Cereus Financial. I will also provide their emails, so if anybody is interested in reaching out directly to them. So thank you so much, everybody, for joining us tonight. And our next one is coming up on October 7th, and that will cover, I believe, 401ks. And David and Michael, if you know what the next topic is, but I definitely know it's 401ks. So yeah, I hope everybody had a good one, and please let us know if you have any questions, or if there's questions that you didn't feel comfortable asking, please feel free to give an email to me, and I will direct it to Michael and David.
Hey, Jennifer, I'm sorry, I don't remember exactly the next one, but I thought it was charitable trusts.
Okay, well, I will look into that one, and then we will let you know.
Okay.
So, but yes, and I'll also include the next one in our in my follow-up email. So, all right, everybody, thank you. Enjoy the rest of your evening. Jane, I hope to see what you're knitting soon. I'm curious. Oh, I love that. I was like, what is she knitting? I love that. I need to do that. I think that would help me concentrate too. So, all right, everybody. Well, thank you. Hope to see you all at the next one.
All right. Thank you. Thanks, Jennifer.
All right. Thank you. Have a great night.
Night.
Take care.
Bye.
Bye.